Hello, everybody. I'm Donna Hawley, the president of the Investment Institute. And on behalf of Andrea Zigothy and myself, we welcome you to our sixth session of the virtual coffee break series. It has been such a continued delight to see so many of our TII community register for each of these webinars. And we also want to say a special thank you to all of you because there are so many newcomers on today, and it's such a delight to see so many new names as well. So to you old timers and to you newcomers, welcome. We're thrilled to have you. So thank you. And we look forward to having the chance to meet up in person sometime again soon. But in the meantime, we're glad to connect with you at least in this way. Today, we are very excited to be able to hear the remarks on the virus, the economy, and the markets from Catherine LeGraw of GMO, and followed by a fireside chat between Catherine and Vanita Gaonkar from Robert Wood Johnson Foundation. Vanita is also one of our beloved editorial committee members, and we are so grateful to both Catherine and to Vanita for doing this for us today. Please take a moment now to locate the Q&A feature somewhere on your Zoom screens. And what we really ask is, as soon as you have a question during the session, please type it in as soon as you have it, as Vanita will be reviewing it throughout the session, and we'll try to incorporate as many of your questions into the discussion as possible. So the sooner we get them, the sooner we can try to incorporate those. So thank you. We will also be having a quick poll at some point near the end of the session for those of you who would like CPE credit. You'll just see a poll come on the screen. It'll be a one-question poll saying, yes, I would like to receive it. If you would like to receive CPE credit, please be sure to just click yes so that we can follow up with you after the session with the necessary forms to fill out. Lastly, I just wanted to say, if you could, after the session, you'll receive an email from us with a survey link. It's just a couple of quick questions, but your input, your feedback means so much to us. This is our one chance to hear back from you because you're only hearing from us this way. We would love your feedback if you would take a moment, and we know our speakers would as well. So please do take a moment to fill that out for us, and we really appreciate your response. Now it is my absolute pleasure to hand this off to Vanita. Thank you.
Thank you, Donna, and thank you for having me today. And thank you, Catherine, for joining me as part of what I'm sure will be a really interesting conversation. For those of you that don't know who Catherine is, she's a senior member of the GMO asset allocation team, and she's one of the portfolio strategists. And she's going to take a few minutes right now to talk to everybody about what GMO's 7-year forecasts are today, a little bit about how they've changed maybe over the last year or so, or certainly before the start of the pandemic. And then we're going to get into conversation about what that all means and how to take that information back and make use of it as everybody who's attending today thinks about the current investment environment and their own portfolio. So with that, I'll turn it over to Catherine.
Thank you. The one thing that is common across investors and strategies at GMO is the belief in the importance of valuation, that the price you pay for an asset and its underlying fundamentals is the strongest predictor of long-term return. In the short term, markets can be irrational for any number of reasons: predicting upcoming political events, reacting to current news, investor sentiment like greed and fear. But eventually, economic reality prevails and prices come back in line with fundamentals. Now, this can be a tricky way to run your portfolio because these cycles can be long-term in nature. So it requires a really long horizon and an incredible amount of patience. My focus, which is asset allocation, is all about coming up with top-down forecasts for the various asset classes we can participate in globally. Our team, the asset allocation team, has been running portfolios for over 30 years. And so this long-term perspective over many cycles is really helpful, especially in challenged market conditions, somewhat like what we're seeing today. So we communicate our views on asset class valuation and where we're finding attractiveness through a series of 7-year asset class forecasts. And the 7 years is meant to reflect, again, that we acknowledge that these cycles take a long time and that it may take a while, for example, 7 years, for asset classes to come back in line with fair value. We've been publishing these forecasts since 1994, so for 26 years. And over that time, they have been a helpful guide and tool for which areas to lean into and which areas to avoid. Now, as you can see from our current asset class forecasts that are on the screen, we are a bit cautious today about a lot of investment opportunities. I'm going to start a little bit by talking about US equities, oftentimes everyone's favorite asset class to talk about. And we have a negative forecasted real return for US stocks right now. We believe that US stocks are quite expensive today. They were expensive at the beginning of the year, but at least at the beginning of the year, that was understandable. These high valuations were supported by very stable economic conditions, stable GDP growth, stable inflation, and also by high profits. Today, they are just as expensive as they were at the start of the year, but economic conditions have deteriorated significantly. So we have a negative outlook there and are generally avoiding US equities. There are pockets of opportunity and attractiveness across asset classes today. And the key opportunity I'd point out for you is emerging markets value stocks. As you can see from this forecast page, we are forecasting that emerging markets value stocks will deliver a return of 9.9 percentage points annually above inflation. I think of emerging markets value stocks right now as kind of a trifecta. You've got cheap stocks, they're much cheaper than stocks across the rest of the world. Within emerging markets value stocks, we're seeing some of the widest spreads we've ever seen between value and growth stocks. So what that means is value stocks are as cheap as they have ever been relative to growth stocks in history. And finally, and this is not embedded in our forecast, this is an additional tailwind on top of this 10% real return we forecasted. The currencies in emerging markets are cheap today as well. Given the great uncertainty we're all facing economically, we like an asset class that offers some margin of safety. So that potentially bad things could happen or it could weather some bad news. And emerging markets value stocks gives you that today. In the developed markets, we haven't shown all of our forecasts here, but in places like UK, Japan, Europe, value stocks are reasonably attractive there as well today. Shifting over to bonds, which are in red on our forecast page, it is hard to like bonds today at such low yields. Given the yields we see in the US, the 10-year treasury at about 65 basis points yield, or across sovereign bonds globally, it's really hard to come up with a forecast where those bonds deliver a return in excess of inflation over the next 7 years. So we have pretty negative forecasts for sovereign bonds globally. Credit does offer some opportunities. Now, unfortunately, credit spreads are not nearly as wide as they were at the end of March. Credit spreads have narrowed considerably, but there are areas you can find where you're actually paid to take credit risks today. And that's what we want. We want to find areas where we're being paid to take the risks that we're taking. So next slide, please. These are our asset class views, and I think the best way to show you how we would actually implement them in a portfolio is by sharing with you the current positioning of our benchmark-free allocation strategy. It's called benchmark-free because it is a relatively unconstrained portfolio that doesn't need to follow or mimic any particular benchmark. We have full flexibility to concentrate in the portfolio in the areas where we have the best ideas. And as you take a look at our benchmark-free allocation, you'll get the sense that today we are quite cautious in our outlook. The key thing we are concerned about is uncertainty. We do not have a viewpoint that equity markets are going to go down anytime in the near term, but we see a lot of economic uncertainty. We don't know how this virus is going to play out. We don't know how governments are going to react if they see an additional surge in cases. And we also don't know what the full economic impact is going to be. So as we invest, we really want to just concentrate on those assets where we're being well compensated for the risk that we're taking. And the one asset class where that's very clear to us in equities that we are being adequately compensated is the emerging market value stocks. So we have a 25% net long equity position today, and that is all in emerging markets value stocks. The next section that you see on our portfolio is in light blue. It's actually equity long short positions. This entire 40% piece of our portfolio is market neutral. The bars in the stacked bar chart reflect long equity positions that we hold, and the labels off to the right of the bar chart reflect offsetting short futures positions to make the overall position market neutral. So we're holding several segments long across equity markets, and we're actually shorting futures, S&P 500 futures, Russell 2000 futures, and EFA futures against them. This reflects a recent move we made to reduce equity exposure in the portfolio after the dramatic runoff in the past quarter or so. And we decided to reduce the equity exposure by shorting futures against equities we hold because we believe there's still a lot of value to be captured from those stocks we like. One thing you might notice our portfolio is we don't hold any long sovereign bonds. We did have a position in US TIPS earlier in the year, but as US TIPS yields went pretty sharply negative, we've rotated out of that exposure. We have some exposure in fixed income through credit and investments, but our real diversifying asset today is liquid, low volatility alternative strategies. And you can see those represented in purple in this portfolio. It's nearly a 20% allocation in our benchmark-free portfolio. So I'm hoping that this brief overview to our philosophy and our current outlook and the positions that we're holding right now will be a good starting point for discussion.
Thank you, Catherine, for that background and that overview on the firm's current views. I thought I'd jump right in and try to level set things since an awful lot has changed over the last just few months. So if you look at your forecasts today, which are predicting over 7 years over the long term, negative returns in many asset classes, maybe very importantly for the attendees today in US equities specifically, how long have you had this cautious view, and how much of it is changes that have come as a result of the pandemic and the more recent economic issues that we're facing?
Yeah, so just to give you a little more perspective on the forecasts and how they change over time, the primary driver of forecast change is price changes. And because they're 7-year forecasts, a simple rule typically is that if prices go up by 7%, our forecasts go down by 1%. And so they have been quite dynamic this year because we've seen such dramatic price moves in assets. From the lows in March to today, we've seen kind of 40% price moves in a lot of equities, which can translate into actually a very large change in our equity forecast from the bottom of the market until today, something as high as even 6 points for some assets. So what we've seen is today, a lot of our forecasts look fairly similar to how they did in the beginning of the year, but at the bottom of the market in March, we had much higher forecasts for equity assets and for credit assets in particular, and even for bonds before bonds sold off and we still had treasuries yielding, 150 basis points or so, we had a higher forecast there. And then just in the past quarter, we've really seen those forecasts come back down again as the markets have surged.
Okay, thank you. That's helpful. If you look back over a longer history of time, I think you mentioned that GMO has been producing these forecasts for 26 years. And obviously the history of the firm goes back a long way and is pretty well known for having a conservative view at a couple critical points in history, some of which precede anything I would remember. How does today's environment and the level of cautiousness and where you're seeing discrepancies in markets, overvaluation, undervaluation, how does that compare with some more recent periods in history where GMO has also expressed some concern about bubbles emerging, say the global financial crisis or the tech bubble in the late 90s or even times before that?
Yeah. We are pretty cautious today. I'd say the two periods in history when we've been most cautious, you just pointed out. So around 2000, around the tech bubble, we were incredibly worried about valuations, particularly in the US, and we saw a wide spread between value and growth stocks. And then around 2007, early 2008, we were worried about all assets. We thought we had a global risk bubble and everything was mispriced. Today, one big difference between now and then is the level of certainty we felt. So in 2000 and 2007, 2008, we felt it was inevitable that these assets were in bubbles and eventually the bubble would pop, and there was some small element of certainty to it. You never know exactly what's going to happen, but you have some sense this can't last forever. Today, we actually feel a lot of uncertainty. We've never lived through a pandemic. We have no idea what the total economic fallout is going to be. And so we are quite cautious. We want to be paid a reasonable risk premium, but we feel that the key reason we want to be paid is because we don't know. We don't know what the fundamentals are going to turn out to be in a short period of time. In terms of, adding other similarities or differences, a way today looks similar to 2000 is we're just seeing these extremely wide spreads between growth and value stocks, and that fascinates us. Growth stocks got really expensive around 2000 globally, and now we're seeing growth stocks similarly expensive, hence we've tilted our whole portfolio toward value stocks. And a difference I'd say between 2007, 2008, in 2007, 2008, we thought all equities were expensive. But today, we actually think emerging market value stocks are cheap. In fact, a 10% forecasted return is one of the best forecasted returns in the history of the GMO forecast over 26 years. So that disparity between US and non-US, that's pretty unique to today.
Okay, that's really interesting. In looking at some of the questions that are coming through from the audience, since you mentioned the broader discrepancy between value and growth, there's a couple more specific questions about what's GMO's forecast on US value stocks, and then kind of a similar question for European value stocks. So could you maybe just spend a moment on comparing value and growth more broadly in those developed markets, and as well as how you'd compare it to that versus the EM value that you mentioned?
Yeah, these questions are really honing in on exactly where the opportunity is today. So I can't recall all the forecasts off the top of my head, but I will say value versus growth is at historic wides everywhere. US, Europe, UK, Japan, emerging markets. So in the US, our forecast for value stocks is, maybe 4 or 5 points higher than our forecast for US stocks. So close to flat or slightly positive in real terms, say maybe positive 1%. And our forecast for US small cap value stocks is actually considerably higher, maybe positive 3 or 4% expected return in real terms today. And I think the other question you asked me about was Europe value. I'd say that's also roughly about a 4% forecasted real return. So forecasted return above inflation. So you're really hitting the areas where we still see good value. And it just makes the point how much of a big difference it makes if you're looking at the value half of the market or the market as a whole.
It seems like, that there are plenty of investors or commentators or others who would have, myself included, not that I'm a commentator, but I would have thought plenty of things looked overvalued, say 2017. I would have thought the ongoing bull market that we were in probably couldn't continue. If you go back 2 years, maybe 3 years, and until recently, I've been on the wrong side of that conversation. What are GMO's thoughts on that, other than these things take time to play out?
It is extraordinary, and everything you're saying, I feel such empathy, because I can remember feeling the exact same way around 2017 or 2018, like, ooh, US is getting pretty frothy. Certainly things are gonna turn around and we're gonna start to see the best performance coming from non-US markets. True, these things can take a long time, and that's pretty much always what GMO says. And when we say a cycle takes on average 7 years, well, on average means a lot of cycles do take longer than that. But we really have struggled with how incredibly long this cycle has been. Yeah. And we've spent quite a lot of time thinking about why has this cycle been able to be so long. And just to give you a sense of one area of research we found pretty interesting, it's really been in the competition in markets. So at the end of the day, we think the mechanism for mean reversion is competitive capitalism. So we've spent a lot of time looking to say, hey, are there there indicators that maybe the US market has been less competitive, more oligopolistic? And could that be a reason that mean reversion hasn't happened as quickly? Do we need to consider that in market dynamics? But to your earlier point, yes, cycles do take a while, and you don't know exactly how stretched valuations are going to get.
Turning to another question from the audience, staying with the theme of value stocks, one of our attendees points out that value stocks include some challenged areas of the market, say banks and financials that are in a low interest rate environment that are obvious. It's more difficult for them to make money with interest rates as low as they've gone than when we're in a rising rate environment. To say nothing of other parts of the value sector that might include old industry type companies or companies that are just facing more challenges in an increasingly technological world. What are your thoughts or GMO's thoughts on that?
Well, first I'd like to make just a quick note that our forecasts are incredibly conservative in how we consider these particular groups of stocks. So I just, in response to that question, gave a forecast for, say, value in Europe. That forecast actually excludes banks altogether. So we have excluded financials when putting together our forecast on a bottom-up basis for as long as I can remember, well before the global financial crisis. And that's simply because some of the quantitative data that you can get from banks can be misleading as you're trying to forecast the entire market for exactly some of the reasons you said, including their leverage. So just to that point, and other old industries, you know, if you're thinking about resources like energy company or mining companies, we're pretty conservative in how we deal with those as well. If they are a large piece of the market, we'll pull them out, forecast them separately, and add them back in. So those value forecasts I mentioned to you, they are not overly influenced by banks or resources companies. Yet we do spend quite a lot of time as a firm looking at banks and resources companies. And I will say, for banks, we see value there, and a group at my firm did put out a paper on the value they see in banks, I think just about a week ago. And some of the key points they made is these companies are just in a much better position than they have been in the past. They're well capitalized. They are in a better position to weather this storm. So we think there is opportunity in banks. And then for resources, also old industry stocks, as it happens, a team at my firm put out a paper on this recently, that they always trade at a discount to the market. They are typically very unloved stocks, but they are trading by far the widest discount we have ever seen. In fact, if I'm recalling the stat correctly, I think that they mentioned in this paper that resources stocks are trading at about an 80% discount to the market, which is pretty extraordinary. So if you are looking for a niche investment opportunity that's just at a valuation extreme, and you could get comfortable with buying energy and mining companies, I mean, that's the quintessential example of a valuation extreme. And because other investors tend to avoid them because they don't want to make predictions about commodity prices, and I don't blame them, those types of predictions are typically wrong, they have been also a very rich hunting ground for alpha historically. So, you know, I think you could find great opportunities in both banks and resources today, actually, but that is not overly influencing the forecast I shared with you.
Okay, thank you. How has, for those folks that are attending that are maybe a little less familiar with the firm's forecast over the last 10 years, how has the QE environment that we've been in, unprecedented central bank liquidity, everything that's been going on at that level, how has that either changed the way the firm thinks about the forecasts that are being made on a global basis, or just how has it contributed to all the analysis and the research that you're doing?
Yes, so the unprecedented monetary policy we've seen globally has influenced our thinking, and the forecasts I just showed you are our base case full mean reversion forecasts. They're pretty similar in methodology to how we've been doing the forecast for the past 26 years, no major shifts. But the fact that there has been such a change in the environment has made us come up with an entirely alternate set of forecasts, an alternate scenario, if you will, that reflects a permanently lower for longer world, permanently lower interest rates, permanently lower return on capital. And when we first started talking about, are we in this permanently lower world, back in 2014, we called it hell. We said, oh, are we in hell? Are we going to have constantly lower interest rates and constantly lower return on capital for stocks? And if so, how do our forecasts look in that environment? We've since rebranded that scenario and we've called it instead partial mean reversion, which is perhaps a bit more friendly. But every month when we run our forecast, we run the full mean reversion scenario, which I shared with you on the screen. And we also run this alternate partial mean reversion scenario. And as we build portfolios internally, we're considering both scenarios side by side because we truly don't know which world we are in. Is this odd environment temporary or is it going to be permanent?
Okay. How do you, a similar question going back over the years that GMO has been doing this, how does GMO, especially when emerging markets returns are looking more attractive relative to some areas of developed market, specifically value, how are you factoring in higher risks in those markets that are maybe specific to the emerging markets world, potential bigger liquidity issues, political risk, all the things that are difficulty shorting, different things that domestic investors can do versus foreign investors, you know, those dynamics aren't really relevant in a liquid US developed market. How are all of those types of things factored into the forecasts in your thinking?
Yeah, so they are factored into the forecast, actually. It's relatively subtle, but in the forecast, we're always making an assumption about what is fair value for this asset. That's calibrated to what's the long-term equilibrium return we're expecting from the asset. And so for a developed market like US, we're saying in equilibrium, these stocks should give us between 5.5% and 6% real return over a full market cycle. For something like emerging markets, we need a little bit more. So for emerging markets as a complete asset class, we are demanding, you know, something more like 6.5 real return over a real market cycle, which means in effect, you're expecting the emerging markets to always trade at a 10 to 15% discount to the developed markets. Now, when I say emerging markets are quite cheap relative to developed markets, that's because today emerging markets overall, not just the value stocks, are trading at about a 50% discount, 30 to 50% discount to US markets. So it's trading at far more than the discount we demand, but there is a small mechanism embedded in the forecast to say, hey, we always need a little bit more from the emerging markets because they are inherently riskier, like you mentioned. And of course, as part of our investment process, we're always constantly assessing the underlying risk of the emerging markets as we're making investments there.
Coming back to something you said, I think in your initial comments or when we just started the chat, that the current 7-year real return forecast for emerging market value, almost 10%, is one of the highest forecasts you've seen in history. Can you maybe compare it with other forecasts for asset classes in the past where things were maybe not quite as high, but just that high, just so people can think through periods of time? Because that does seem on the high end of what anybody would be predicting for any asset class today, unless it's a private market one.
It's a very good return for stocks. You're right. For taking equity risk, 10% return, we should be happy with that. So other times we've seen similarly good returns, and it certainly isn't the only or the very best return we've ever seen for anything in history. But emerging markets we thought looked similarly attractive around 2000. So we had a really positive point of view on emerging versus US in 2000. And in 2009, early 2009, February 2009, we had some of the best forecasts we've ever had for equities. And then pretty much all equity asset classes were coming in with real forecasted returns between kind of 9 and 12%. You know, US quality stocks, developed ex-US emerging market stocks, they were in the kind of double-digit real return range. So it's not unheard of in the history of our forecast, but just to give you a little bit of context, it's really good. Like, it's pretty rare that things are getting over 10% in our forecasting framework.
Okay. How do real assets fit into your thinking, either as part of a potential allocation or just forecasts in general? That's a lot of, that's a part of a number of people's portfolios that are attending today, whether that's gold or other types of real assets that historically have kind of provided a diversifying impact in a big portfolio.
So real assets or anything without a price that we constantly observe are tricky for us in our forecasting framework, because the key elements in coming up with a forecast each period is that we observe a price in the marketplace, and then we have some measure of the underlying true fundamental value. So for things like private real estate or anything infrastructure, private infrastructure, we're just not getting the prices or the fundamental data that we could to make a forecast in this framework. For anything that's liquid and consistently traded, it is possible to do this. So we do have a forecast for US REITs, which would be a proxy for real estate, and would give you a sense there. We have a forecast for TIPS, which many would consider a real asset, which is really keyed off of the current real yield, which unfortunately for US TIPS is quite low right now. And let's see what else would be in real assets. You mentioned gold. Gold we struggle with because it's really hard to say what is the fair value of gold. So that is not an area where we have a forecast. That one we think is pretty tricky to do. I'd never say never, but we do not have a forecast for gold right now. And then other things we think about as real exposure, as I mentioned, is I think things like resources stocks, you can think of like stocks, and they are a decent proxy for a real asset, but with an equity risk premium. And there we look at their valuation relative to the market compared to history. So that gives you an example of, hey, there are these pockets that are publicly traded where we can come up with a decent estimate using our framework. And then unfortunately, you have to admit, hey, there are some assets that would be real assets where our framework just doesn't do a great job.
Okay, that's helpful. I'm going to turn away from equities for a few minutes unless we start getting some more questions on it. But as you have increased the suggested allocation to more alternative assets, so I think what you refer to as generally alternative strategies, which encompasses a lot of different types of things, and then also a large suggested allocation to something like equity long short, which is a little bit more straightforward. What are your return forecasts for some of those areas as concepts as part of a portfolio to get to that 5% long-term return?
Yeah, that's really tricky. How do you come up with a forecast for some of these strategies? I'm going to answer the easier part of the question first, which is something like equity long short, because there it can fall right out of our framework. We have a forecast for the groups we hold long, we have a forecast for the thing that we're shorting, and we can translate into a forecast for the long short asset. It's basically the forecast for the long side, which maybe would be, say, value stocks, minus the forecast for the short side, with some adjustment for the fact that we're managing a long short portfolio and there's some, if you will, volatility drag there. So we do need to make an adjustment for that. But if you think about the forecast for, say, if it was as simple as value versus the market, value stocks having a forecast about 5% higher than the market, then value versus the market as a long short position would have something like a 5% forecasted real return. And that flows, relatively neatly out of our framework. It's not perfect. For something like the other alternative strategies that we invest in, we have much less of a time varying forecast. So the three that we're invested in right now, event driven, think about this as like merger arbitrage. Yeah, there are things you can look at that are a guideline. For example, you can see, hey, what are the spreads of current deals or the average deal of the portfolio? And you could subtract from that the probability of default or the average probability of default over time. The problem with using that as a forecast is actually one of the features we like best about the strategy, which is it's so short duration. Your deals are going to last 6 to 12 months. And so given how dynamic that portfolio is and how short duration these estimates I'm mentioning are, I don't think that's necessarily a great predictor of your long-term returns from that asset. So one thing we love about it is its short duration, and that's part of the reason we're investing in it. But I think that's one reason we actually would struggle to have a good forecast for it. Likewise, the other two strategies are really pretty pure alpha strategies. They take dynamic long and short positions based on their own underlying forecasting frameworks. And actually, both of the strategies that we're invested in, a systematic global macro and a fixed income absolute return strategy, they gross up and shrink their own exposures based on their opportunity set. So for us to be second guessing them and increasing or decreasing their allocation in our portfolio, we think would be counterproductive. So we really think about those as kind of cash plus 5% over the long term type contributions to the portfolio, but that's not directly falling from our forecasting framework. I hope that's helpful perspective.
No, I think that's one of the things a lot of allocators tend to struggle with is that many of us have allocations to areas that are harder to measure on kind of an ongoing basis, because as you pointed out, there isn't a lot of data available, whether this is a private market strategy, whether it's an absolute return strategy. And so when we enter one of these sharp downturns, it's very hard to know what's going to work, what's going to protect you, what's not going to work, and then how to shift allocations in response to it. So
that's right. I mean, one of the things we like about those strategies and the reason that we're allocated to them is because they have low duration and low beta. And the two things we're good at forecasting are those market-based returns. So
got it. Turning to credit for a minute, you mentioned earlier that there's some pockets of credit where you think investors are being paid to take some risk. Could you spend a moment on that?
I mean, this is one where it's a great comparison. You've been asking me, hey, how do these forecasts compare to recent history? At about the beginning of the year, when we looked across credit markets, there wasn't great opportunity. Again, it depends on which pocket of credit you're looking at, but we were seeing credit spreads about 20th percentile relative to history at the beginning of the year. So pretty low relative to history. And then in March, everything just blew out. I mean, for some pockets of credit within high yield, US high yield, you were seeing for a moment credit spreads of 1,000, 1,100, that's kind of 98th, 99th percentile versus history. That's just excitement for the asset allocator. And even things like emerging country debt were looking like maybe 90th percentile versus history. Those credit spreads have all come in, but generally credit spreads are still better than median. So you're talking, for things like high yield and emerging country debt, you're talking things that are maybe 60th percentile, 65th percentile relative to history, absolutely ownable. You feel you're being paid for credit risk, but it's not the same excitement you feel when you're offering credit spreads that you only very, very rarely see.
Okay. We've gotten a couple questions from the audience. I think it appears as though you're making a pretty strong case for EM value. So to wrap it all up into sort of a three-part question, there's a question for you to have a chance to advertise your firm a little bit more. Does GMO have a product specifically for investing in EM value? Is there a market proxy you would recommend investors look at for EM value? And for people that even want to take a look at it on their personal portfolio. So I think everybody's a little bit interested to figure out how to access this opportunity.
I'm so glad everybody's interested in EM value. This is if I achieved one thing today, I'm excited about that. So to answer questions in order, yes, GMO has an externally available emerging markets value product. It's called the GMO Emerging Markets Fund. So that one is easy to remember, and it's quite value oriented today. I'd say compared to something like MSCI Emerging Markets, depending on which valuation metric you look at, it's trading at about a 30% discount to MSCI Emerging Markets. So pretty cheap portfolio today. To take the second part of the question, which is, hey, what's a good public market proxy? What would you suggest? I would say the reigning index you could refer to, and the index I would refer to would be MSCI Emerging Markets Value. The big caution I would give you about this index, and I do want to make the distinction that the group we forecast in our forecast is not that index, because the way MSCI does it, they've required that the value universe have the same country allocation as the overall universe, as MSCI Emerging Markets. And what that ends up with for the value universe is a huge concentration in banks and resources stocks. I think the MSCI Emerging Markets Value Index is something like 60% financials and resources. So just a caution there when you think about that as your public market proxy. And as I mentioned, when we think about the group we forecast, we don't just want to be forecasting banks and resources. And so we come up with our own group for asset allocation to come up with a forecast. But I would say that that's the reigning value benchmark. And then for your personal portfolio, this is not my area of expertise. I myself, have looked around at ETFs, and you can find some that are value oriented or fundamentally oriented. You kind of have to look a bit, but I would say none immediately comes to mind that, hey, this is the premier offering in EM value space. But even if I turned you on to emerging markets, I would be happy. So
yeah, and an ETF, it must be, or just an index, as you mentioned, it must be hard to carve out some of that bank and resources exposure. On a
so just beware.
Yeah. Okay. Thank you. Staying with the EM value, since this seems to be the area folks are most excited about, you mentioned three things. Stocks are cheap overall. It's the widest spread between value and growth that you've seen in quite some time, and currencies are cheap. Could you just break those down a little bit more in terms of how those three pieces add up to that 10% forecasted real return?
Sure, I would be happy to. So Yes, the stocks are quite a bit cheaper than developed markets, maybe not extremely cheap overall. So for our forecast for MSCI, or sorry, not MSCI, for emerging markets overall, something like 3% forecasted return, which is quite a lot better than the forecasts you saw for US and for international markets. So the emerging markets are kind of 30 to 50% cheaper than the developed markets, and that leads to our forecast for emerging markets overall being quite a bit more attractive than our forecast for international or EFA markets overall, or our forecast for US. So that's the first part. Then value spreads being historically wide. We look at value and growth as halves of the market. So the cheaper half of the market and the more expensive half of the market on a composite valuation metric. And we look at that through history. And actually what you find when you look at it through history is value growth cycles are very orderly behaved and quite mean reverting. So if you think of value stocks, they typically on average trade at something like a 20% or 25% discount to the market. Today, they're trading at a much wider discount to the market. Think of 35 to 40% discount to the market. And so we are having an additional forecasted return on top of our emerging markets return, just to focus on the value segment of the market and the ability of that value piece of the market to mean revert to normal. So that's an additional, 6% or so on the forecast. And then the third piece is actually not built into our forecast at all. The forecasts that you see that I shared with you, they are currency neutral. They are forecasts for each market in local currency terms. So the nice thing is, if anybody who called in is not a US dollar investor, they're just as relevant for you as for the US dollar investors. But people often want to ask, hey, what's the currency component of return? Well, emerging market currencies are looking a bit better than, one standard deviation cheap today. And if you wanted to be quite aggressive, which I am not going to encourage, you could kind of roll that up to an additional point to maybe 1.5 of forecasted return for emerging markets. I think that's aggressive to do. That's not how we show it on the forecast page. The way I like to think about it is, hey, it's more likely to be a tailwind than a headwind to your future returns for emerging markets.
Okay, that's some great detail. Thank you. Before we got started, shifting away from EM value, unless we see some more questions, you and I were chatting about just some confusion about sort of what's happened over the last few months. Confusion on my part, certainly.
Us as well. We're right there with you.
And if I was going to put it in layman's terms, or if I was talking to my parents or something, I would say, well, the world is definitely worse than it was at the start of the year. And as you mentioned, yet valuations or stocks rebounded very quickly, and valuations, at least in some parts of the market, are right back to where they were at the start of the year. And there's definitely more economic uncertainty, even if it isn't as bad as maybe was thought to be the case a couple of months ago. So we've seen this very quick recovery in some parts of the market, and particular high growth areas, SaaS companies, et cetera. I asked you then, I just thought maybe you could share your thoughts with the audience. Do you think all of that is being driven by the lower yields or lower rates that have come down, and so investors really don't have any place else to go, so kind of continued encouragement to take more risk than maybe is appropriate at this point in time, just because there's no return anywhere else, and so it just keeps pushing stocks higher?
I mean, I think that's somewhat rational and understandable. I think if someone says, I look at the yields of bonds and cash and I just can't possibly accept those yields, so I'm going to invest in stocks, and I realize I might only get 2% real return from stocks, but I'm okay with that. That's the best I can do. I think there's something rational and reasonable about that. I'm worried that that's actually not what's happening right now. So as we look at what's happening in the marketplace and we kind of say, hey, what are the signals we're getting from the market? What are the pieces of data we're picking up? It feels anecdotally and to some extent quantitatively, you can point to things that it's not in a market who's just, hey, I'm resigned to earning really low long-term equity returns. It feels like a market that's excited, that's greedy, that has a bit of fear of missing out. And some of the data points I would point to around that is we've seen massive openings of new retail accounts. I mean, if you look at TD Ameritrade or E-Trade, account openings are up 100% year over year for retail accounts. valuations. We see crazy things happening in the market, like a company like Hertz announcing bankruptcy and the equity price is going up. We see Tesla at a valuation that's equal to the valuation of 9 other major automakers. And all of these things just feel bubbly. They feel frothy. They feel like a major disconnect between market valuations and true underlying economics and fundamentals. And that makes us incredibly nervous. And you had asked me earlier about valuations, like, didn't you think the market looked really uncomfortably expensive in maybe 2017 or 2018? And yes, we did. But one thing that kind of held us back from calling it a bubble was we weren't seeing any of these signs of froth. And now we are, and it's concerning. Yeah.
Okay. There's been a few questions from the audience. I'm going to try to summarize them into one question about kind of catalysts, or not that you're going to call what's going to happen and when, because that's, you know, well, if you could do that, then
that'd be
you should do that. Yeah. But are there anything you look for or any catalysts that you see? I think some of the folks in the audience, and actually myself included, you know, we have investments in managers that are value oriented, whether it's emerging markets or IFA or in the US. And, you know, there's some side eye going on from people that are like, is this still a good idea? Because it feels like it's really not.
Yeah, and for us, that's like when it's definitely a really good idea. Don't back away now. Yeah, so actually GMO is terrible at catalysts. Even backward looking, it's sometimes hard to figure out what the catalyst was for a big valuation shift. But as I said, this market is different. And one thing that is different about this market is we have a real economic recession driven by decisions we've made around this virus and trying to control the virus. And there's been a lot of speculation about, hey, what kind of recovery are we going to have? Are we going to have the V-shaped recovery, the U-shaped recovery, the L-shaped recovery? And so we're not trying to call a catalyst, but there are some things that we are constantly looking at to saying, hey, does this actually really change our mind about what we're going to see going forward? I think the simple example, and it seems something that all investors are looking for, is will there be an effective vaccine? And I am not a diseases expert. We do not have a diseases expert at GMO. We're all trying to become, you know, mini diseases experts. But a vaccine is usually a very long-term solution. You have to test it for a while, and it's really hard to find an effective vaccine. So if you were asking me, hey, what's one thing that would make you feel really great about how the economic tide is going to turn, I think seeing an incredibly effective treatment to this virus could be a complete game changer. Yeah, just to give you one thing, but I wouldn't say that's meant to be a catalyst for any of our views. It's just something we'd look for that might, you know, change our thinking about where we're going economically. For things like, hey, is value versus growth going to mean revert? Is US versus non-US going to mean revert? It's not meant to indicate it should be a catalyst for that. Although I will say value sold off much worse than growth did in the downturn. So if we see a big resurgence, you know, value deserves to win.
Okay. Maybe as we come to the end of things, we could just shift direction a little bit. There's a couple questions on China, whether it's the political situation overall, the relationship between the United States and China, how that has evolved with the start of the pandemic. How does any kind of thinking on that fit into certainly emerging markets forecasts or just overall notions on global uncertainty? Because that's a pretty big factor for all asset classes.
I mean, China's huge. We typically don't do single country forecasts. We want to forecast something that's big enough to be an entire asset class. Now, US is, and we basically think UK and Japan are as well, but China is becoming that entity, that it is an asset class in and of itself. And as far as a part of the emerging markets, it's over a third of the emerging markets. So it's an entity. And we actually think China being such a big part of the emerging markets actually makes them a bit safer and a bit more stable. China is an inherently quite stable entity. And one thing we've looked at across all countries is how are they reacting to and dealing with this virus? And what we found was it wasn't necessarily the emerging markets that were a basket case and the developed markets that were completely in charge of the situation. Some emerging markets like China, Taiwan, Korea did a great job controlling the virus and getting things under control. And other developed markets, United States included, have struggled. So it's not necessarily US versus emerging who's safer in this particular scenario. And finally, I guess the thing we look at is who has the ability to throw money at this problem, and China certainly does as well. So we absolutely care about China. It's a big risk factor in global markets and investing in emerging markets. But net, we think it's reasonably well managed, and they are able to manage through a lot of economic and other environments decently well.
Thank you. Well, I think we're coming to the end of our time. So a huge thanks to Catherine for sharing GMO's views and all of her research and opinions. And thank you to everybody for participating today. And I'll turn it over to Andrea to finish up.
Thank you. Hi, everybody. Vanita, Catherine, that was incredible. We're both getting texts and emails. Girl power, this is amazing. You got two amazing women on screen. So just thank you both. Vanita, you're so good at integrating all the questions in and being such a moderator and editorial committee for us. We're so grateful. And Catherine, to reconnect with GMO has been such a pleasure. Dana and Lydia, if you're listening, thank you for helping us recruit Catherine. So really, if you could hear the crowd listening, they'd all be clapping right now if we were in person. So really appreciate it. Thank you. Just a few comments. There is something coming across your screen right now asking if you're interested in receiving CPE credits for the webinar. So please click yes or no. We do need that information from you. That would be really helpful. And just a few upcoming, we're very excited for in 2 weeks from today, July 30th. We have a LPGP conversation that we're in the middle of putting together with Albert Cha from Vivo Capital on life science investing. So you won't want to miss that one. Hopefully he will touch upon the vaccine and maybe answer some questions on that as well. Biotech happens to be one of the biggest topics that we're discussing with our editorial committee that we're trying to get good coverage on for our fall forum. Then we also have our 2 asset owner virtual meetups. If you haven't done one yet, these are really a lot of fun, low key, laid back. 8 to 10, no more than 10 people on each Zoom call. And we've been doing them every other week. So our next one is August 4th at 2 p.m. And then we have one specifically for OCIOs and fund of funds and consultants who have been asking to get on some of the asset owner ones, but we've created one just for you. So August 18th at 2 p.m. So please shoot me an email if you'd like a personal invite to that. And lastly, our in-person forums. We are going to try October 26, 27. That's kind of still, right now we're doing it. It's an open air forum. It's outside in a barn in North Carolina. But if the world doesn't take a turn for the better, that will be pushed off as well. We would never put anybody in harm's way. And May 17th, 18th will be our other membership meeting in 2021. So just wanted to say thank you to everybody, and we'll look forward to seeing you at the next one. Thanks again. Bye-bye.
Thank you.